If you owned a second home, you likely wouldn't let it sit empty and silent. You'd find a tenant, sign a lease, and begin to collect a monthly check. It's the most common way to turn an idle property into a source of steady income. You can apply this exact same logic to the shares of stock in your investment account. Even if a stock isn't moving, you can rent it out to other investors using a strategy called a covered call. While options trading can sound like complex math, an option is really just a contract. In this scenario, it functions like a standard lease agreement between you and another trader. By selling a call option, you are acting as a landlord for your shares. You are writing a rent-to-own contract, giving someone else the right to buy your stock at a later date in exchange for an upfront fee today. There is one major requirement. To write a covered call, you must own 100 shares. You cannot write the contract unless you have the shares to back it up. Because you already own the shares, you aren't making promises with assets you don't actually have. If the buyer decides to use the contract, you simply hand over the shares already sitting in your account. This approach transforms a stagnant stock into a cash-generating asset, much like putting a paying tenant into a house that was previously sitting empty. To see how this works, imagine you own 100 shares of a tech company called XYZ. With the stock priced at $100 per share, your total investment is worth $10,000. You decide to offer a rent-to-own deal on these shares to the rest of the market, setting a standard contract window of 30 days. First, you set the strike price. This is the future sale price you agree to today. In this example, you agree that the buyer can purchase your shares for $105 each at the end of the month. In exchange for this right, the buyer pays you a premium. Think of this as a non-refundable deposit. For this contract, the buyer pays you $300 upfront. This $300 is yours to keep immediately. It goes into your account today and it stays there regardless of what happens to the stock over the next 30 days. You have now completed the setup. You have $300 in cash in your pocket today, in exchange for agreeing to sell your shares at a specific price next month. Now let's look at scenario A. 30 days pass and the stock price doesn't move at all. It stays flat at $100, well below your $105 strike price. At this point, the buyer will simply walk away. There is no reason for them to pay you $105 for a stock they can buy on the open market for only $100. This is a win for you. You still own all 100 of your shares and you kept that $300 deposit. Because you still have the shares, you can write a new contract and collect another round of rent. But what about scenario B? In this case, the stock rallies and breaks past your $105 ceiling, hitting $120 before the month is over. Now the buyer will use their contract. Your shares are called away, meaning you are required to sell them to the buyer for the agreed price of $105. Even though the stock is at $120, look at your math. You made $500 from the stock rising from $100 to $105, plus you kept the $300 premium. That is a total gain of $800 in 1 month. You still walked away with a significant profit. The only thing you lost was the extra gain the stock made above that $105 mark. This strategy involves a specific choice. You are choosing to take a guaranteed cash payment today in exchange for giving up the potential for higher profits if the stock price happens to surge. Because of this, covered calls are best used with stable, slow-moving stocks. They are less effective for volatile companies that might double in value overnight. The real risk occurs if the value of the stock drops sharply while you are under contract. If the company crashes, your shares will lose value just like any other investment. However, that upfront fee you collected acts as a small cushion. Because you have that extra $300 in your account, your total loss will be slightly less than if you had simply held the stock alone. By writing covered calls, you stop waiting for the market to move and start generating your own returns. You own the property, you collect the check, and you get paid to wait.